Okay, this video is going to give you a very quick introduction to accounts for single entities. So then, obviously every entity needs to prepare financial statements, but what are their purpose? So they provide information about the financial position, performance and cash flows of an entity, all very important, especially when it comes to decision making. Essentially, all of those reports show us how effective management is. It is able to tell us how things are being run and are we succeeding? Is a company profitable? So IAS 1 then defines a complete set of financial statements as follows. So firstly, we need the statement of financial position as at the end of the period, as well as the statement of profit or loss as at the end of that period also. We need the statement of changes in equity for the period, as well as the statement of cash flows. They are the 4 financial statements that need to be produced at the year end. In addition to this, any notes, such as disclosure notes, need to be made and need to be written up. So these are notes which are taken if significant accounting policies have been compromised and thus an explanation is needed. So I guess the next question then is, where does the responsibility lie in terms of preparing and presenting the financial statements? Ultimately, it is down to the board of directors to focus on this. They must all be presented and produced in line with fair presentation, as per IAS 1 guidance. So financial statements shall present fairly the financial position, the financial performance, and cash flows of an entity. So entities complying with all relevant accounting standards almost always will achieve this objective. So what are the requirements then for fair presentation? Well, firstly, faithful representation must be shown on the effects of the transactions. Select definitions and recognition criteria are set down in accordance with the conceptual framework, and accounting policies will be applied in line with IAS 8, which is the one of accounting policies. The present information is relative, but it must be presented in a manner which is also reliable, comparable, and understandable. So this ultimately links to your fundamental and enhancing qualitative characteristics. Additional disclosures must also be provided if the requirements of an IFRS standard or that of an IAS are insufficient to enable users to be able to understand all potential impacts. So, if acting in line with the IFRS standard would be misleading, an entity had ought to disclose the following. So management have concluded that financial statements do present the financial information fairly. An entity has complied with all of the applicable IFRS standards, other than whereby they have had to challenge them to show a true and fair view within their business, and reasons as to why the FRS would be misleading had it been adhered to. There is obviously going to be a financial impact upon net profit, loss, assets, liabilities, equity, and cash flow. So do bear in mind, this would happen very, very rarely, and there would have to be a good reason for doing so. Going concern then, just a little recap. Remember that all financial statements should be prepared on this basis, and this tells us that a business is going to continue to trade for the foreseeable future. Financial statements should also be prepared using the accruals basis. So all this means is that transactions should be recorded in the accounting period to which they actually relate to, regardless of when they were actually paid or received if it's income. Consistency. So presentation and classification of all items, assets, liabilities, income, expenses, equity, everything should be consistent from one period to the next. Changes are allowed in the event that they would be deemed more appropriate or required by an IFRS standard. Materiality and aggregation then. So IAS 1 states the following. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that the primary users of general purpose financial statements make on the basis of those financial statements which provide financial information about a specific reporting entity. Remember, immaterial amounts should be aggregated with amounts of a similar nature and need not be disclosed separately. Offsetting then. So assets and liabilities and income and expenses. At no time should these be offset, except when offsetting is required or allowed by an IFRS. So do be careful. Sometimes, just for the benefit of the doubt, it is easier if you just post both the asset and the liability and both the income and expense, just to ensure that you do and you have met that requirement. Comparative information then. So this should be disclosed in respect of the previous period for all amounts reported in the financial statements, unless an IFRS requires or otherwise allows. So just to note, IAS 1 states, financial statements should be presented at least on an annual basis. They should be issued on a timely basis. So that is either 6 months of the end of the reporting period for public entities, or if it's a private entity, 9 months at the end of the reporting period. So you're now going to have a look at the statement of financial position. So what items are going to appear in the financial position statement in accordance with IAS 1? So property, plant and equipment, investment property, intangible assets, financial assets, investments accounted for using the equity method, biological assets, inventories, trade and other receivables, cash and cash equivalents, the total of assets classified as held for sales, as shown in IFRS 5, trade and other payables, provisions, financial liabilities, liabilities and assets for the current tax, as defined in IAS 12, deferred tax assets and liabilities, also defined in IAS 12, liabilities included in disposal groups as held for sale, non-controlling interest presented within equity, and issued capital and reserves attributable to the owners of the parent. So those are the items that are going to appear in the statement of financial position. So there will be notes drawn up to the statement of financial position, and these should be presented at the end of the financial period. So all tangible assets will be analysed and they will be divided into class: property, plant and equipment. Receivables will be analysed, and this will be separated into amounts receivable from trade customers, receivables from related parties, prepayments and any other amounts. We will also classify our inventories. So this will go into merchandise, production supplies, work in progress, materials, and finished goods. Provisions will also be analysed, showing provisions for employee benefits separate from anything else. Equity capital and reserves are analysed, shown separately. The various classes are paid in capital, share premium, and reserves also. So share capital and reserves disclosure then. So for each class of share capital, you must disclose how many shares have been authorised, how many shares have been issued and paid or unpaid, and what is the value per share. There will then be a reconciliation needed to be done for the number of shares, as well as the shares held by the entity itself or that of submission and that of subsidiaries. Shares will also be reserved for insurance. So, nature and purpose of each reserve, owner's equity. So a number of dividends that were proposed or declared after the reporting period, but before the financial statements were authorised for issue. It's a number of any cumulative preference dividends not recognised. So we have current assets and we have current liabilities, but we also have non-current assets and non-current liabilities. So how do we know if it's a current or a non-current item? Well, a current asset, it's genuinely expected to be realised in or is intended for sale or consumption in the entity's normal operating cycle. It's normally short term, which means it's generally for trading purposes. It's going to be within a 12-month period, so it's going to happen in this financial year. And cash and cash equivalents is an example of this. Current liabilities then are expected to be settled in the entity's normal operating cycle, so again are expected to be settled within the next 12 months and by the end of the financial period. These are held primarily for the purpose of being traded, and the entity does not have any unconditional right to defer settlement of the liability for at least 12 months at the end of the reporting period. So statement of changes in equity then is something else you need to be aware of. So this contains basically a quick summary of it, and we're going to have a look at the effect and impact it has upon share issues and dividends, and what does that mean in terms of a change reflection. So ordinary and equity shares. So shareholders then own a percentage of the entity's net assets. Voting rights are going to be attached to them shares. Year-end dividends may be paid to shareholders based on an entity's performance. The dividend is going to be paid on an amount per share, and the dividend will first be proposed by directors, they will then be declared, and they will then be paid. They should only be accounted for, though, once they have been declared. That whole process needs to be complete. Dividends may be interim. So in order to account for ordinary or equity shares, the best thing to do would be the following. We debit the bank account. It's money going in. We credit share capital and we credit our share premium. Remember, our share capital is simply the nominal value, and the share premium is the excess that a shareholder has paid for that share, all those shares above what it's actually worth. So the payment of ordinary shares then, we would then debit retained earnings, which would be shown in the statement of changes in equity, and we would credit our bank account. If the dividend is declared but remains unpaid at the year end, we would debit retained earnings and we would credit the dividend payable. Preference shares then. So shareholders own a percentage of the entity's share capital. voting rights are not attached to the shares. The year-end dividend is going to be paid to shareholders based on an investment percentage, and this should be accounted for on an accruals basis. So preference dividends are accounted for as follows. So if classified as equity instruments, we would debit retained earnings in the profit or loss account, then we would credit cash in our statement of financial position. If, however, they are classified as a liability instrument, we need to debit finance costs in our profit or loss, and we need to credit our accruals. Statement of profit or loss then. So information that is to be presented in the profit or loss as stated in IAS 1 is as follows. So we've got revenue, we've got finance costs, we've got the share of profits and losses of associates and joint ventures, we've got our tax expense, single amount for the total discontinued operations. And there are other things that may crop up, but these are the few that you need to be aware of. So just like the financial position, there are notes that have to be done in line with the statement of profit and loss. So firstly, we need to ensure that we present information about the basis of preparation of the financial statements and the specific accounting policy adopted for significant transactions. We disclose any information required by any IFRSs that are not presented elsewhere in the financial statements. We provide any additional information which is not presented elsewhere in the financial statements, but is relevant to understanding them in more depth. Notes are usually presented in the following order. So we would have a statement of compliance with the IFRSs. We would then have a summary of significant accounting policies applied, supporting information for items presented in each financial statement in the order in which each line item in each financial statement is presented. So other disclosures then that may be needed include any non-financial disclosures that you feel the need to disclose,